At exactly 9:30 this morning, the silver market didn't dip. It didn't pull back. It didn't even crash. It froze. The kind of freeze that doesn't happen in a healthy system. The kind of freeze that happens when the machine is about to reveal something it was never built to admit. Silver hit $98 an ounce, $2 away from triple digits, and then the American screen went dark. Not a lag, not a glitch, a hard stop. And while New York locked the doors, Shanghai kept trading like nothing happened at 110, a spread that shouldn't exist in a unified global market. A gap that only appears when reality splits into two timelines, the paper timeline and the physical one. And here's the part that should make your stomach tighten. The halt wasn't designed to protect you. It was designed to contain what happens next. Because when silver is $2 away from a psychological breaking point and the exchange chooses silence instead of price discovery, it isn't a safety feature anymore. It's an alarm. It's the moment the system admits it can't handle the truth. People will tell you this is normal, that circuit breakers are routine, that markets pause to cool off. But that story only works if the market is still functioning. If buyers and sellers can still meet, trade, settle, and move on. Today, they couldn't. Today, the trade became too honest. This channel doesn't do predictions. We do autopsies. And right now, we're standing over a market that just flatlined in public. Because what happened at $98 wasn't just a price event, it was a structural event. The kind you only understand after it's already taken something down. And in the background of that halted screen, the real market didn't pause. It rerouted. Phones lit up. Dealers tightened inventory. Industrial buyers stopped waiting politely. They started hunting. And when the hunt begins, the posted price becomes theater. Let's talk about what a futures halt actually means. Because most people hear halt and think it's a polite timeout. In theory, an exchange stops trading when prices move too fast. So panic doesn't turn into disorder. Official language says it protects orderly markets, helps price discovery, keeps things fair. But that's not what today looked like. Today looked like containment. Because silver didn't halt because it was moving too wildly. It halted because it was moving too accurately, toward a level the paper system could not afford to print. Here's the ugly mechanic underneath the pretty headlines. Futures markets are not built to deliver metal. They're built to settle in cash. The vast majority of silver contracts never result in bars leaving a vault. They're closed out, rolled forward, netted, offset, paid in dollars. It's a promise factory, not a delivery service. And a promise factory works perfectly until the day too many people show up asking for the product. That day was today, because the buyers stepping in weren't just gambling for a quick profit. They were industrial users, manufacturers, entities that don't want exposure to silver. They want silver. They want material they can melt, stamp, wire, and ship into machines that power the modern world. So when buy orders hit like a wave at 98, the market makers, the institutions paid to provide liquidity, did something that tells you everything. They stepped aside. They stopped offering to sell. And when the sellers vanish, price doesn't negotiate. Price launches. The exchange then faces two options. Let the number run until the system snaps, or pull the plug before the snapping becomes visible. They pulled the plug. And if this is already making sense, do me a favor, hit like, subscribe, and stay here with me. Because this isn't just about silver. It is about what happens when a financial system built on confidence suddenly has to operate under scrutiny. Also, drop a comment and tell me where you're watching from. New York, London, Dubai, Singapore. Because geography matters again. In a fracture, money stops being global and starts becoming local. Now watch the split screen reality, because this is where the story turns from alarming to historic. While American trading stopped at 98, Shanghai kept trading at 110. And that gap wasn't a curiosity, it was a confession. In a functioning market, a spread like that gets erased by arbitrage. Traders buy where it's cheaper and sell where it's more expensive until prices converge. But arbitrage requires one thing: access. You can't buy the cheap side if the cheap side is frozen. So instead of prices converging, metal flows. Not theoretically, physically. Because if one region stays open and offers a higher price, the supply moves toward that price. East, always toward the market willing to pay reality. This is why spot price stopped being a real term months ago. Dealers were charging premiums far above the screen price just to deliver actual metal. 15%, 20%, sometimes more. That's not a premium, that's a separate market. That's the physical world putting a tax on paper promises. The screen price becomes a reference point, not an offer. It's the price of a claim, not the price of a thing. And the moment claims start breaking, the entire system becomes a confidence game played on borrowed time. Behind the scenes, while the public stared at a frozen number, the real market was doing what real markets always do when trust breaks. It bypassed the middle. Refiners started getting calls. Dealers started tightening terms. Industrial buyers began contacting mines directly. Because when supply is tight and delivery is uncertain, Nobody wants a contract. Everybody wants certainty. And certainty has weight. You can't print it. You can't smooth it over with a press release. You either have it or you don't. And right there, in that widening gap, paper at 98 and physical pushing north of 130, you can see the system failure in its purest form. Not a software issue, not a temporary imbalance, a failure of architecture. A market designed for speculation suddenly being forced to function as a supply chain. And when it fails with the only tool it has left, silence. At this point, the panic stops being emotional and becomes mathematical. Because the derivatives world rests on an assumption so fragile, it almost feels like a joke that promises and metal are basically the same thing. That a contract to deliver silver later is interchangeable with silver in a vault today. But a promise is not a thing, and today the market learned the difference in real time. The reported open interest in silver futures dwarfed the registered inventory available for delivery. It was leverage stacked on leverage, promises piled on top of a base layer that was never thick enough to support the building. And the only reason the building stood for years was because most people never tried to move in. But the composition of demand changed. Solar manufacturers need silver. Electronics need silver. Medical tech needs silver. The world is electrifying, and electricity needs conductivity, and conductivity needs silver. These buyers aren't playing a chart. They have production schedules. They have contracts. They have penalties for delays. So when the futures market couldn't behave like a supply chain, the supply chain began to treat it like irrelevant noise. Now add the most dangerous ingredient of all, concentration. In silver, a small handful of large banks sit on a massive share of the short positions. They aren't evil villains in a movie. They're the plumbing. They sell contracts, hedge exposure, collect spreads, and assume they can always source metal when they need to. That assumption collapses the moment physical price disconnects from paper price, because then hedging becomes impossible without paying reality, and reality is expensive. This is when risk managers start doing the math that no one wants to read out loud. If a bank has massive short exposure and silver runs, losses don't rise linearly, they compound. Margin calls hit like a drumbeat, liquidity drains, counterparties pull back, credit lines tighten. And what begins as a metals issue suddenly becomes a balance sheet issue, a solvency issue. That's why a halt isn't a solution. It's a pause button on a bomb. So here's the question I want you to sit with, and I want you to answer in the comments because it tells me exactly how you see the world. If a market has to stop trading to prevent the true price from appearing, is that still a market, or is it already a controlled system pretending to be one? The most bitter irony is that high prices should fix this. Economics 101 says rising prices stimulate production. More supply arrives, equilibrium returns, the panic fades. But mining doesn't obey classroom timelines. A mine can't restart overnight. It can't conjure equipment, workers, permits, and infrastructure because the chart turned bullish this week. And if a mine shut down 3 weeks ago because $70 silver wasn't profitable, that mine doesn't magically become a faucet at 98. Restarting takes months, sometimes years. The lead time is brutal. The capital is cautious. Because the last time silver spiked, it crashed hard enough to scar an entire generation of investors and executives. So even now at the edge of triple digits, producers hesitate. Not because they don't want profit, because they don't trust the price. Meanwhile, demand isn't hesitating. Solar doesn't pause because the exchange is frozen. Electronics manufacturing doesn't slow down because an American screen is dark. The inventory gets consumed regardless. Every hour the halt continues. The real world keeps drawing silver out of circulation. And when industrial stockpiles thin, production lines don't adjust, they stop. That's when a commodity becomes strategic. That's when nations start caring. That's when supply chains become geopolitical. And if that wasn't enough, silver isn't just industrial. It has a second identity the modern world tried to bury, monetary metal. When central banks expand balance sheets, when currencies lose purchasing power quietly through inflation, when debt becomes too large to repay. Honestly, sophisticated capital starts looking for a store of value that can't be printed. Silver begins re-entering allocation models not as a trade, but as insurance. Long-term holders don't sell into chaos. They accumulate into it. That means tighter supply, even at higher prices. That means fewer ounces available to satisfy a system already running on fractional reality. So when the screen finally unfreezes, and it will, the question 1TB, did silver break $100? Or the question will be what price they choose to admit and what rules they choose to change so that admission doesn't bankrupt the people who wrote too many promises. Because buried in every contract is an escape hatch. Force majeure, emergency settlement, cash in place of metal, a clean word for a dirty outcome. You thought you bought silver. You received dollars. And the difference between those two is the difference between a system that honors contracts and a system that protects itself. This is why today matters. Because a market halted at 98 isn't a pause in trading. It's a moment of revelation. The system didn't stop because it was broken. It stopped because it was working too well, working well enough to expose the shortage beneath the surface. And now you know what the fight is really about. It's not about price, it's about delivery. It's about trust. It's about whether money is still a contract society or confidence performance with emergency exits for the insiders. So I will leave you with the only question that matters when the screen comes back to life. When the market reopens, do you think they'll let silver print the truth? Or will they pay cash to keep the illusion alive?